Silver price crash, the brutal trap or the perfect buying opportunity. A tidal wave of red has washed over the precious metals markets, leaving a trail of devastation in its wake. The serene landscape of steady gains has been violently disrupted by a torrent of selling pressure, a phenomenon that has shaken even the most seasoned investors. Silver, the volatile and often unpredictable cousin of gold, has been at the epicenter of this financial earthquake. It has been hammered with a ferocity that suggests a fundamental shift in market sentiment, prompting a cascade of questions about its immediate trajectory. The primary among them, echoing in trading pits and investor forums alike, is a simple yet profound one. How much lower can the price possibly fall before finding a stable floor? The current market environment is a maelstrom of conflicting signals and high-stakes speculation. For weeks, the narrative of precious metals as the ultimate safe haven has been the dominant theme, driving prices to dizzying heights. Investors, wary of geopolitical instability and looming economic uncertainties, flocked to the perceived security of gold and silver, creating a powerful upward momentum. However, this fortress of investor confidence has been breached, and the resulting panic has been palpable. The market is now grappling with the brutal reality of a sharp reversal, a downturn so severe that it compels us to reevaluate the very foundations upon which the recent rally was built and question the sustainability of those high valuations. The catalyst for this dramatic sell-off can be traced not to a complex economic report or a surprising corporate earnings miss, but to the subtle, yet powerful realm of international diplomacy. The recent signs of a potential thaw in the protracted and often contentious trade dispute between the United States and China have sent shockwaves through the financial world. These tentative steps toward reconciliation, symbolized by the planned meeting between the two nations' leaders, have significantly altered the market's risk perception. The easing of these tensions has diminished the immediate appeal of bullion as a hedge against global instability, leading to a rapid unwinding of the safe haven trade that had propelled metal prices upward. This geopolitical development has been compounded by another significant factor: the market's anticipation of the U.S. Federal Reserve's upcoming interest rate decision. There is a broad consensus, with market-implied probabilities soaring to 97%, that the central bank will announce a quarter percentage point rate cut. Ordinarily, such a move would be bullish for non-yielding assets like gold and silver, as lower interest rates reduce the opportunity cost of holding them. However, in the current context, it appears that this widely expected decision has already been fully priced into the market, offering little in the way of fresh support to counteract the bearish sentiment stemming from the trade war de-escalation. The tipping point occurred when gold decisively breached the psychologically crucial $4,000 per ounce threshold. This level had acted as a significant line of support, and its violation triggered a cascade of automated sell orders from algorithmic trading systems. The velocity of the decline was staggering, with gold plummeting by over $116, a drop of nearly 3%, to settle at approximately $3,997. This marked the first time in a considerable period that gold had traded below this key level, signaling a significant victory for the bears and intensifying the selling pressure across the entire precious metals complex. While the fall in gold was dramatic, the impact on the silver market was nothing short of catastrophic. Silver, known for its higher beta and greater volatility, experienced a beating of epic proportions. The price plunged by more than 4% at its lowest point during the trading day, a violent move that erased a substantial portion of its recent gains. After reaching a lofty high of $48.74, the price came crashing down, hitting a nadir of $46.20 before finding a precarious footing around $46.82. This brutal price action has left investors reeling, questioning the metal's short-term prospects. In the immediate aftermath of this market convulsion, a clear divergence in expert opinion has emerged, creating a fog of uncertainty. On one side, analysts from institutions like Capital Economics have adopted a decidedly bearish stance, revising their long-term forecasts downward. They have posited a potential price target of $3,500 per ounce for gold by the end of 2026, a prediction that suggests the recent rally was an unsustainable bubble driven by transient fears. This perspective argues that as geopolitical and economic conditions normalize, the fundamental justification for such elevated precious metal prices will evaporate, leading to a prolonged correction. Conversely, other seasoned market observers, such as Jeffrey Christian of CPM Group, offer a more nuanced interpretation of the current price action. Christian suggests that the recent surge from $3,800 to nearly $4,400 was largely a speculative froth driven by the escalation of trade tensions. From this viewpoint, the current downturn is not the beginning of a new bear market, but rather a necessary and healthy correction. It represents an unwinding of that speculative premium, bringing prices back into alignment with underlying fundamentals. This school of thought posits that $3,800 could serve as a solid foundation for gold's next major leg up. This analytical discord highlights the central tension gripping the market, the conflict between short-term speculative flows and long-term fundamental drivers. The day-to-day price movements are clearly being dictated by macroeconomic headlines and shifts in geopolitical risk perception, as evidenced by the market's reaction to the U.S. China trade news. However, beneath this surface-level volatility lies a set of powerful, enduring forces that are poised to shape the future of precious metals, particularly silver. These fundamental factors, including central bank policy, industrial demand, and supply-side constraints, are often overlooked in the heat of a market panic, but are crucial for any long-term strategic analysis. One of the most significant, yet often underappreciated, pillars of support for the entire precious metals complex is the relentless and systematic accumulation of gold by central banks around the world. This is not a speculative endeavor, but a strategic, long-term policy of de-dollarization and diversification of foreign exchange reserves. These institutions are not fickle, short-term traders. They are price-insensitive buyers with a multi-decade outlook. Their continued net purchases create a steady and substantial source of demand that acts as a powerful counterbalance to the speculative selling scene in the futures markets, providing a structural underpinning for gold's valuation. The unwavering commitment of central banks to bolster their gold reserves has a significant and positive spillover effect on the silver market. While central banks do not typically hold silver as a primary reserve asset, the institutional validation of gold as a cornerstone of the global financial system burnishes the appeal of all precious metals. It reinforces the narrative of hard assets as a necessary hedge against fiat currency debasement and systemic financial risk. As gold's role is reaffirmed and its price is supported by this official sector buying, silver, often referred to as poor man's gold, invariably benefits from the enhanced investor sentiment and capital inflows into the sector. Looking beyond the immediate market noise, it is imperative to consider the future trajectory of monetary policy, particularly from the U.S. Federal Reserve. The anticipated quarter-point rate cut is likely just one step in a broader easing cycle. As global economic growth continues to decelerate and inflationary pressures remain muted, central banks will be compelled to maintain an accommodative stance. A sustained low-interest rate environment is exceptionally bullish for silver. It systematically erodes the value of fiat currencies, increases the attractiveness of non-yielding assets, and encourages investment in tangible stores of value as a means of wealth preservation against the insidious effects of inflation. The long-term bullish case for silver is not merely a monetary argument. It is deeply rooted in the metal's indispensable role in modern industry and technological innovation. Unlike gold, a significant portion of silver's annual demand comes from industrial applications where it is consumed, and in many cases not recycled. Silver's unique properties, including its superior electrical and thermal conductivity, make it an essential component in a vast array of high-growth sectors. This industrial demand provides a solid and growing base of consumption that is largely independent of the speculative whims that dominate the paper markets, creating a powerful long-term tailwind for its price. The green energy revolution, for instance, is profoundly dependent on silver. The metal is a critical and irreplaceable component in the manufacturing of photovoltaic cells for solar panels. As the world accelerates its transition away from fossil fuels toward renewable energy sources, the demand for solar installations is set to explode. This global energy transition is not a cyclical trend, but a secular shift that will require a massive and sustained supply of silver for decades to come. Each new solar panel installed represents a permanent increase in the cumulative industrial demand for the metal, steadily tightening the market balance. Simultaneously, the electrification of the global transportation fleet represents another monumental driver of silver demand. Electric vehicles contain significantly more silver than their internal combustion engine counterparts, using it in everything from battery packs and electrical connectors to heated windshields and advanced driver assistance systems. As governments around the world implement policies to phase out gasoline and diesel cars, the production of electric vehicles is projected to grow exponentially. This automotive transformation will create a new and voracious source of industrial silver consumption that the market has only begun to price in. The relentless march of technological progress in other areas further solidifies silver's essential role. The rollout of 5G telecommunications networks, the proliferation of Internet of Things devices, and advancements in medical technology and antimicrobial applications all rely on silver's unique physical and chemical properties. From circuit boards and RFID tags to wound dressings and water purification systems, silver is woven into the very fabric of our modern technological infrastructure. This diverse and expanding range of applications ensures that industrial demand will not only remain robust, but will likely accelerate in the coming years, placing increasing strain on available supplies. This brings us to the other side of the fundamental equation, the increasingly constrained global supply of silver. The narrative of ever-expanding production is a fallacy. The world's primary silver mines are maturing, and ore grades are in a state of secular decline. This means that mining companies must process significantly more rock to extract the same amount of silver, leading to a substantial increase in production costs. Discovering new high-grade primary silver deposits has become exceedingly rare, and the lead times required to bring a new mine from discovery to full production can often exceed a decade, creating a structural bottleneck in the supply chain. Furthermore, it is crucial to understand that the majority of the world's silver is not produced from primary silver mines. Over 70% of newly mined silver is actually a byproduct of mining for other industrial metals, primarily lead, zinc, and copper. This geological reality makes the silver supply highly inelastic. A surge in the silver price does not automatically incentivize a proportional increase in production, as mining companies' primary decisions are driven by the economics of the base metals they are targeting. This inherent supply-side inflexibility means that the market will struggle to respond quickly to any significant and sustained increase in demand. The combination of these powerful demand drivers and significant supply constraints points toward an inescapable conclusion. A structural supply deficit in the silver market is not a remote possibility, but a looming inevitability. The world is on a trajectory to consume far more silver for industrial purposes than the mining industry can realistically produce. For years, this deficit has been met by drawing down above-ground stockpiles. However, these inventories are finite, and as they are progressively depleted, the market will reach a critical inflection point where a fundamental scarcity becomes apparent, leading to a dramatic and potentially explosive repricing of the metal. Therefore, while the current market is fixated on the short-term headwinds of de-escalating trade tensions, the prudent, long-term investor should view this downturn as a strategic opportunity. The present sell-off, driven by ephemeral geopolitical headlines, offers a chance to accumulate a mission-critical industrial commodity and a timeless monetary asset at a significant discount. The fundamental case for silver has not been weakened by the recent price action. If anything, the prospect of acquiring it at these lower levels has made the long-term value proposition even more compelling for those with the foresight to look beyond the immediate market noise. Based on this comprehensive analysis, a plausible floor for silver during this corrective phase appears to be in the low $40 range. While a temporary spike down into the high 30s cannot be entirely ruled out in a moment of peak market panic or a liquidity-driven event, Such a move would likely be short-lived and aggressively bought. The confluence of rising industrial demand, constrained mine supply, and supportive monetary policy creates a powerful zone of fundamental support that should prevent a more catastrophic and sustained collapse in the price, establishing a new and higher base for future rallies. This price consolidation, even if it proves to be a painful and volatile process in the short term, is ultimately a healthy and necessary development for the market. It serves to shake out the weak hands and speculative froth that accumulated during the rapid ascent, creating a more stable and sustainable foundation. A period of sideways trading and base building around the low $40 level would allow the market to digest the recent gains and prepare for its next major upward move, which will be driven not by fleeting sentiment, but by the undeniable and powerful fundamentals that are tightening the market balance with each passing day. The prospect of revisiting $50 an ounce silver is not a question of if, but when. Given the powerful secular trends at play, a return to this psychologically important level seems highly probable. If the current geopolitical calm proves to be temporary or if new economic uncertainties emerge, this could happen as early as the latter part of this year. However, even in a more stable macroeconomic environment, the relentless pressure from the growing supply-demand imbalance makes a move toward $50 and beyond a likely scenario for the coming year, rewarding those investors who maintain their conviction through the current period of volatility. The key lesson from this episode is the critical importance of distinguishing between price and value. The current price of silver is being buffeted by the transient winds of market sentiment and algorithmic trading. Its intrinsic value, however, is anchored in its irreplaceable role in technological advancement and its enduring status as a real monetary asset. In times of market turmoil, it is easy to lose sight of this distinction and succumb to fear. However, history has repeatedly shown that periods of maximum pessimism are often the moments of maximum opportunity for those who have done their homework and understand the long-term fundamentals. The dynamics of the U.S. dollar will also play a pivotal role in silver's trajectory. While the dollar has shown resilience, the long-term outlook is fraught with challenges, including a burgeoning national debt and a Federal Reserve committed to an inflationary policy stance. Any significant and sustained weakening of the dollar would act as a powerful tailwind for silver, as the metal is priced in dollars on the international market. A falling dollar makes silver cheaper for foreign buyers and enhances its appeal as a hedge against the declining purchasing power of the world's primary reserve currency, creating a reflexive loop of increasing demand. As we look ahead, the potential for unforeseen supply chain disruptions adds another layer of bullish potential to the silver equation. A significant portion of silver production is concentrated in geopolitically sensitive regions of the world. Any major political instability, labor strikes, or changes in environmental regulations in key producing countries like Mexico, Peru, or Chile could instantly remove a substantial amount of supply from the global market. Given the already tight supply-demand balance, any such event would have an immediate and dramatic upward impact on the price, catching many unprepared market participants by surprise. The investment landscape is also being reshaped by the increasing accessibility of precious metals to retail investors. The proliferation of exchange-traded funds, digital metal platforms, and a more efficient online bullion dealer market has democratized access to silver investment. This growing base of educated and committed retail buyers, often referred to as stackers, provides a steady and resilient source of demand for physical metal. Unlike institutional traders, these investors are typically less sensitive to short-term price fluctuations and are focused on long-term wealth preservation, adding another layer of stability to the market. It is also worth considering the psychological dimension of the market. After a prolonged period of consolidation and relative neglect, the recent rally has put silver back on the radar of the broader investment community. While the current downturn may have temporarily dampened enthusiasm, it has also served to highlight the metal's potential for explosive gains. As the fundamental story becomes more widely understood, It will likely attract a new wave of capital from generalist investors and institutional funds seeking diversification and exposure to the compelling themes of electrification, green energy, and monetary debasement. Ultimately, the path forward for silver will be a tug-of-war between the short-term, sentiment-driven paper markets and the long-term, physically-driven fundamental realities. In the immediate future, volatility is likely to remain elevated as the market continues to react to geopolitical headlines and central bank communications. However, over a more extended time horizon, the immutable laws of supply and demand will prevail. The relentless growth in industrial consumption, coupled with a constrained and inelastic supply, is creating a one-way street toward a significant supply deficit, and consequently, a substantially higher equilibrium price. In conclusion, the current violent downturn in the silver market, while unsettling, should be viewed within the broader context of a powerful and developing long-term bull market. This is not a signal to abandon ship, but rather a clarion call to reevaluate, and for those with a long-term perspective, to potentially reinforce positions. The convergence of supportive monetary policy, a global technological and energy transition, and a structurally constrained supply chain is forging an exceptionally bullish future for silver. The present price hammering is merely a temporary storm that will ultimately give way to a much brighter and more valuable horizon. The narrative that will define the next decade for silver is one of scarcity. For too long, the market has operated under the illusion of abundant supply, an assumption that is being challenged by geological realities and exponential demand growth. As this illusion shatters, the market will be forced to confront the metal's true value not just as a financial asset, but as a strategic and irreplaceable industrial commodity. This fundamental repricing will be a disruptive and powerful process, rewarding investors who have the patience and foresight to look past today's fear and focus on the undeniable realities of tomorrow.